Okay, guys, so welcome to tonight's class. So what we'll be doing, we will work through this scenario, and then we will be answering as much of the question as possible. There's quite a bit of things happening. As a short scenario, simple, but there's a lot of important concepts coming through. So we won't be able to do the entire question, but we will basically do as far as we come, and then we will continue tomorrow, in the next lesson. Okay, so they say, Awesome Brands is listed on the Johannesburg Stock Exchange and owns and operates retail stores across South Africa. ABC sells clothing and general merchandise at wholesale prices to the public. All the companies in the group have a 28th February year end. Okay, so there you can just give you a basic background. Okay, so just take note of that. So 28th February is our year end, so just keep note of that. So they say Delicious Exotic Foods, so DEF, in an attempt to diversify its operations, ABC acquired 75% of the ordinary share capital and voting rights of DEF on 1 March 2018. ABC had control over DEF in accordance with IFRS 10 consolidated financial statements from that date. The purchase consideration for the acquisition was payable to the previous shareholders as follows. Okay, so we'll go through that now. So what's important over here? There's a few important things. Okay, so we acquired a 75% interest on 1 March 2018. On 1 March 2018, we had control over DEF. So that's important. So number one, we have control, so ABC have control over DEF on 1 March 2018. So 1 March 2018 is the date of acquisition. So from the date of acquisition, we need to consolidate. Okay, so from 1 March 2018, we will consolidate. Why? Because we have control. Very, very important. Now they're telling us how the purchase consideration, they're giving us the purchase consideration for the acquisition of 75% interest. So what's happening over here? The consideration is being transferred to the previous shareholders of DEF. Okay, so just take note of that. So here we have a cash consideration of 610 was paid on 1 March 2018. A cash payment of 155,000 will be transferred on 28 February 2020. So just take note of this. There's a cash payment of 155 that will only be transferred in 2 years' time. Okay, so very important. So when we work out the consideration, we need the present value today, not the amount in 2 years' time. So that means what we're going to have to do this 155, we're going to have to present value it for 2 years so we can get a value today. ABC issued, yes.
Is that a deferred consideration?
Yes, deferred payment, a deferred payment, yes. Okay, so ABC issued 5,000 Rand, ABC issued 5,000 of its ordinary shares to the shareholders of DEF. The fair value of the shares was 58 Rand per share on 1 March 2018. The fair value increased to 60 Rand per share on the registration date of the shares on 18 March 2018. So as you can see, they're giving you two amounts. Remember, we need the consideration at the date of acquisition. So therefore, we're going to use the fair value of the shares on 1 March 2018 and not the fair value of the shares on 18 March. Okay, very important. They say a performance clause was included in the purchase agreement whereby ABC is obliged to transfer an additional cash consideration of 150,000 Rand on 31 August 2020 if the revenue of DEF for its 2020 financial year is 30% higher compared to the 2018 financial year. The fair value of the additional consideration was estimated to be 60,000 Rand on 1 March 2018 and 45,000 Rand on 28 February 2019. The revenue of DEF had increased by 14% in the 2019 financial year. The changes in fair value of the additional cash consideration is as a result of post-acquisition date events. Okay, so this here is known as a contingent consideration. So this is a contingent consideration where an additional payment will be made based on some future event. Okay, so when you have a contingent consideration, the company has to estimate a value at the date of acquisition. So therefore, they are saying they are estimating an amount of 60,000 Rand on 1 March 2018. Okay, so that is the amount we're going to have to include in the consideration. So the total consideration is the cash amount of 610, is the present value of the 155, is the market value of the shares 5,000 times 58 Rand. So remember 58 Rand, that's the market value of 1 March 2018. And then here's a performance, here's a contingent consideration. A contingent consideration meaning just a possible payment in future. So we have to take the market value. We have to estimate the market value as at the acquisition date. So as at 1 March 2018, the estimate 60,000 Rand. So that will be included in our consideration.
Sorry, first.
Yes.
On the shares, we are taking the price, the 5,000. So if it was a building, that is the cost and the fair value.
So again, if it was what?
If there was a transfer of a building with the cost and the fair value, I believe we'd take the fair value. So what's the difference with the shares?
So if there was, I didn't get the first part. If there was a transfer of what?
Of a property, maybe a building.
Yes.
We would include the fair value of the building as part of the consideration.
Yes.
But here for the shares, we are taking the what?
Taking the fair value. It is
so the 18 March figure is not important.
No, we always take the market value at the date of acquisition. So what is the date of acquisition? 1 March 2018. So the fair value at that date is 58 Rand. So we're going to say 58 Rand per share times 5,000. We don't take the 60 Rand because the 60 Rand is the registration date. That's got nothing to do with the acquisition date value.
Okay, thank you.
Okay. Okay, so they are saying over here, in accordance with the purchase agreement, ABC also transferred a machine with a carrying amount of 250 to DEF on 1 March 2018. The machine had a fair value of 225 and a remaining useful life of 4 years and a residual value of 5,000 Rand. So here's a machine. Once again, we're going to take the fair value. Okay, happy with that? Okay, so lastly, over here, before we come to this over here, we'll deal with that now. So they say, apart from the cash consideration of 610 paid on 1 March 2018, ABC also incurred legal fees of 15,000 Rand, which was paid directly to assisting attorneys. ABC paid share issue costs of 10,000 Rand directly to the stockbroker on 18 March, which was the registration of the 5,000 shares in the name of the previous shareholder. Okay, so share issue costs must, transaction costs must not form part of the consideration. Okay, so it is not included in the 610. So what's very important, sometimes these transaction costs will be included in this amount over here. You don't want it included in there, okay? Because remember, the consideration does not include transaction costs. So because it is not included in there, we do nothing. If it was included in here, we'd have to subtract it. Okay, so that's very important. So before we move on, I want you to do one thing for me quickly. But remember, to discount this amount, we're going to need an appropriate discount rate. So the discount rate we will use, they'll give it to you generally at the end of the question under additional information. So if I go to our additional information, here you can see an appropriate pre-tax discount rate of 10% per annum compounded annually. Okay, so we're going to use 10% as our discount rate to discount this 155. Okay, so what I want you guys to do, I'm going to give you only 5 minutes, okay, to try and calculate the consideration for me. But basically, I'm going to tell you where this whole thing fits in. Okay, so I'm just going to stop this quickly. Okay, so one of the important calculations when it comes to group at the date of acquisition. Okay, so when it comes to groups or subsidiaries specifically, at the date of acquisition, we're going to need to calculate goodwill. Okay, so you calculate goodwill only for a subsidiary at the date of acquisition. So the way we calculate goodwill is consideration. Plus NCI less fair value of net identifiable assets. Okay, so that is what I will calculate goodwill. There will be a slight adjustment when you do change in ownership, so we're not going to deal with that now. Okay, so this will equal goodwill. Or if it's a negative, then we call it a bargain purchase gain. Okay. So what I want you to do for me, and I'm going to give you about 5 to 7 minutes to calculate the consideration, and then we're going to compare. Okay, so I'm going to give you guys 5 minutes. So why I want the consideration is very important, because we need it for the goodwill calculation. So I already gave you a brief explanation of what to include in the consideration. So I just want you quickly to do the calculation for me. So I'm going to give you about 5 minutes, 5:07. I'm going to stop you, then I'm going to do it with you. Okay. So can I give you that 5 minutes to work out the consideration? Okay, what did you guys get so far? You guys done calculating it?
Yes,
Yes,
we're just doing the consideration only.
yes.
Okay.
Are you guys done, or can I continue? You need some more time? You need like another minute or two, or can I continue?
I think a minute only.
Okay.
I think we can go.
Okay. Let's get going. Okay. So you just need to tell me how you feed, but let's see how we're going to go about doing it. Here's this now. So to work this out, so we're going to calculate consideration. We're going to list all the items that they gave us over there. So there is cash payment. Okay, you can put a date there. I'm not going to pull a date there. I'm just going to call this deferred payment. Okay, deferred cash payment. I think the next one was issue of shares. Other one was contingent consideration. And the last one was, I think it was equipment.
Machinery. It's machinery.
Machinery. Okay. Okay. Okay, so for the cash amount, we're gonna say 610. Okay, that was given. So just so you know, this is only for your own, this is notes for yourself. You don't put this in an exam. Okay, so take note, the action costs are not removed because it is not included. Okay, if it was included in the 610, you'd have to remove it. Okay, very, very important. Okay, the deferred payment working to, so working to deferred payment, we're gonna have to work that out. Okay, so we need a present value. They're giving us an amount we're gonna pay in 2 years' time, but we need an amount today. So we need the present value. Okay, so that means in order to calculate the present value, we're gonna need the future value, PMT, in, and I. Okay, so this is what we want. This is what we want. So future value, oh man. The future value was given to us as 155. Okay, that was given to us as 155. There is, so remember PMT, so remember future value is the lump sum payment at the end of the period. So the end of the period is 28 February 2019, or whatever it was, 2020. So that is a lump sum payment at the end. That is why I know it is a future value amount. PMT, that is a fixed regular payment. There is no fixed regular payment, so I'll make it 0. N is 2, because remember we are 1 March 2018. This payment only going to be made 28 February 2020. So therefore it's 2 years out from acquisition date. And I, so this is important, this is not I from a financial management point of view. This is I from a financial accounting point of view. So I, from a financial accounting point of view, is always a pre-tax discount rate. We must always take a before tax discount rate. So they gave us a before tax, so we can take it as is. If they give you an after tax, you must convert it back to before tax. Okay, very, very important.
So it also goes with the payment files, confirm?
Sorry? Yeah, but in accounting, they won't. That's correct. But in accounting, there hardly ever will be a payment. Okay.
Okay.
Okay. So, but yes, so if you have a payment, it will also be before tax. So remember, the reason being is from an accounting perspective, tax has a separate line item called income tax. So accounting accounts for tax separately. That is why everything from an accounting perspective that goes through the income statement must be before tax, because tax is accounted for in a separate line item called income tax. Okay.
Okay.
Okay, so what is this now? So we're going to say equal present value. So they want I, then they want in, then they want PMT, then they want future value. And remember, it was always put end of period or beginning of period. So 0 is end of period. Okay, so there we go. So PMT is 128. So we bring it in over here. Remember, you must always bring it in positive. That's just how the calculation works, that we have that it comes into negative. Okay. Now we're going to go issue of shares. Issue of shares is simply going to be 5,000 times 58 Rand. Okay, so 5,000 times 58 Rand. So the number of shares, we want the market value at the date of acquisition. So the number of shares is 5,000. The market value at the date of acquisition is 58 Rand. We don't take the registration date because that is not the acquisition date. Okay, so it's going to be 5,000 times 58 Rand. Then we have the contingent consideration. So a contingent consideration is where there is a possible future payment based on some uncertain future event. The uncertain future event is whether or not you're going to reach a revenue amount that is 30% higher than whatever data gave. So that is a future uncertain event. So when you have a contingent consideration in your consideration, then you will have to take the fair value, the best estimate at the date of acquisition. So the best estimate at the date of acquisition was given to us as 60,000 Rand. Okay, so we're happy with that. Sorry.
Sorry, Fires, to take you back a little bit. You said in accounting, we account for tax separately, right?
Yes.
So we need our figures before tax, because we have a separate line for tax. That's pre-tax.
Okay. Yeah.
All right.
Yes, pre-tax, correct.
Okay. Then now we are in management accounting. We want post-tax. It's the opposite, right?
Yes, that's correct.
So our 10% here is an appropriate pre-tax discount rate is 10% per annum.
Yes.
So so that, okay, that position is correct, that we are using a pre-tax discount rate.
Yes.
Oh, okay. Okay.
Okay. Can you just give me a moment? I need to take a call quickly. That's fine. Just 2 minutes.
Okay. All right.
Okay, so we're happy with, can you hear me? Should you hear me? Yeah, should you hear me? So, so we're okay with, you have any other questions before we move on to complete the calculation? Okay, I can move on. Okay, so what you must take note over here. So here is an important concept over here now with the machinery. So generally we take the market value. Okay, so generally we take the market value at the date of acquisition. However, in this scenario, what you must understand is that we are transferring machinery to as part of the consideration. Okay, in the end, the machinery, we just go and show you quickly. So have a look over here. They say, in accordance with the purchase agreement, ABC also transferred a machine with a carrying amount to DEF. Okay, so just take a note. They are transferring the machine not to the previous shareholders. The 4 bullet points above is a transfer to the previous shareholders. Where this this paragraph over here highlighted is a machine not transferred to the previous shareholders, but transferred to the company, DEF. Now, what you must take note is that in the first bullet points, in the first 4 bullet points, the consideration is going into the hands of the previous shareholders, where the one highlighted below, the consideration, which is a machine, is not going into the hands of the shareholders, but it's rather going into the hands of the company. Now, remember, after the transaction, the company is going to be controlled by ABC. So therefore, a machine that ABC owns in terms of ABC's books, ABC is still going to control it, but not in the ABC's books, but rather in the books of DEF. So that's an important aspect to take note. So basically, before and after the transfer of the machine, ABC still controls the machine. It is just that before the transaction, ABC controls the machine in ABC's books, whereas after the transaction, ABC controls the machine in DEF's books. That's important to take note. So when you have a transaction of this nature and the fair value is less than the carrying amount. So when you have a transaction like this, where before and after the item, the PPE item is going to be in the hands of the new shareholder, then you must ask yourself, is the carrying amount of that asset more than the fair value? If the carrying amount is more than the fair value, you cannot use the fair value, but you will have to use the carrying amount. Okay, so that's very important, extremely important. There's a special paragraph in IFRS 3 that explains this. So I think the paragraphs with consideration in IFRS 3 is around, I can't remember which paragraphs it is, but under consideration, there's a few paragraphs. One of the last paragraphs under consideration talks about this issue. Okay, so there's 2 aspects to take note. Number 1, that before and after the transfer of the asset, ABC still controls it. And number 2, the fair value is less than the carrying amount. So if both conditions hold, then you must use the carrying amount. Okay, so that's very important to take note. So what we're going to use.
Confirm, Pais.
Yes.
If the carrying amount was 225 and fair value was
then you use the carrying amount. I mean, then you use the fair value.
Oh, you use the big amount there.
Yes.
Okay.
Okay. So just take a note of that. Okay, so that's only that one.
Sorry, Faiz.
Yeah.
You also mentioned the scenario where you said the asset is being transferred to DEF, and ABC is going to be controlling the asset, but this time in DEF.
Yeah.
Had the scenario been they're transferring asset to previous shareholders, it was going to be different.
Then yeah, then you just use the fair value, even though the fair value is less. Okay.
Oh, I see.
Okay.
Okay. Thank you. Thank you for that.
Okay, so just take note of that. Okay, so these are important principles. Okay, I don't know whether you're going to be tested on this or not, but I just thought I would share it with you. Okay. I mean, it's part of the question. Okay, so that is how we have to do it. So I just want to bring in the lawyer's fees so you know how to deal with it. Lawyer's fees, and the other one was broker's fees, whatever it was. Okay. So the lawyer's fees must not form part of the transaction. The lawyer's fees must not form part of the transaction. So therefore we make it 0. Okay. So the lawyer's fees is not part of the transaction and is not included in the cash payment. If it was included in the cash payment, you'd have to take it out. Okay, very important. The broker's fees is a share issue cost. Okay, so the broker's fees is a share issue cost. Share issue costs must reduce. Okay, so share issue costs must reduce the amount of the issue of shares. Okay, so that is very important. So basically, if you want to be basically make it more clear, you want to bring in the broker's fees over here. Okay, so the broker's fees must reduce that 290. So just take note of that. So the broker's fees in terms of the scenario was 10,000 Rand. Okay, so the broker's fees in terms of the scenario was 10,000 Rand. So very important. I don't know if they test you on this, but this is a thing that gets tested often, at least through UNISA, because it's made very clear in the in IFRS. Okay, so it's something that is there are specific paragraphs on brokers' fees and on lawyers' fees. So what you must know, a transaction costs must not be included in the consideration. However, only when it comes to share issue costs or debt issue costs, then you must treat it in a certain manner. So you need to treat it in terms of IFRS 9. And basically the way IFRS 9 deals with it is that share issue cost reduces the amount of the shares. Okay, so that's very important to take note. If lawyer's fees was included in over there, you'd have to reduce that cash payment amount because transaction costs should not be included in the consideration. So if I add this up, so this would be my consideration. Okay, consideration. So my total consideration is going to be that whatever that is, 1,328 rand. Do you have any questions on that before we move on to the next? Any questions before we move on?
Not from my side.
Okay, any other guys?
Not me.
Okay,
I just wanted to ask something.
yes,
So
sure.
with regards to this transfer, there is no deferred tax element in it because it's something that has been transferred.
Sorry, so say again, I didn't hear.
I'm saying that there's no deferred element in this machinery that was transferred internally, right?
No.
Okay, thanks for that.
Okay. Okay, so let's have a look. Okay, so we're happy with that. Happy, okay. So remember, it's not part of the question. I'm just showing you how to calculate goodwill because ultimately you're going to need it. Okay. Ultimately, we're going to need goodwill, even though it is not specifically asked. Okay. So in the next lesson, we're going to go through the actual required, but I just want to work through this goodwill thing. Okay, so that was a consideration. Now let's move back to the scenario. So we calculated goodwill. We calculated the consideration, very important, okay? Not every question is going to have a complicated consideration, but just take note, you're going to need to know how to determine consideration if it is all of those type of issues come through. Okay. Okay, then they say the accountant involved in the transaction identified the following issues at the acquisition date. DEF had a share capital of 100,000 issued shares amounting to 100,000 Rand and retained earnings amounting to 1.2 million Rand. DEF had a secret recipe on 1 March 2018. The future economic benefits from the secret recipe are legally protected. The expected useful life of the secret recipe is 20 years on 1 March 2018, and the fair value is 180,000 Rand. DEF has not recognized an asset in its separate financial statements in this regard. Land with a cost price of 200,000 Rand had a fair value of 300,000 Rand on 1 March 2018. The fair value of the land decreased to 210,000 Rand at 28 February 2019 as a result of the review of the Constitution relating to property rights. It is the policy of DEF to account for land in accordance with the cost model as per IAS 40 investment property. Just take note, when you have an acquisition, so when you gain control, you then have an acquisition. Okay, now IFRS 3 deals with the accounting treatment at the acquisition date. So IFRS 3 deals with the accounting treatment at the acquisition date. After the acquisition date, these other accounting standards apply. So IFRS 3 talks about the acquisition method. And IFRS 3 says the acquisition method involves 4 primary issues. So number 1, you need to identify who is the acquirer. So who is acquiring who? So for our purposes, that's generally simple. So the acquirer is ABC. Okay, in the real world, that's a lot more complex, but for our purposes, it's going to be clear. Issue number 2, you must identify the date of acquisition. So the date of acquisition is the date that you gain control. So once again, for our purposes, it'll be fairly straightforward. In the real world, it's not as straightforward. Okay. Then issue number 3 is that all assets and all liabilities must be measured at fair value. And that is why they're giving us these fair value amounts, because we would have to make adjustments in order to ensure that the carrying amount of the assets are adjusted for fair value. Okay, very, very important. And then issue number 4 is that we have to determine goodwill. But we can only determine goodwill after we calculate consideration. We can only determine goodwill after we calculate NCI, and we can only determine goodwill after we calculate the fair value of the net identifiable assets. Now, that's very important, the word identifiable. So firstly, you need to have fair value of all assets and all liabilities, but more specifically must be the identifiable assets. So what is that? Okay, so what you must know, in some instances, a company cannot recognize certain assets. So typically an intangible asset, not all intangible assets are recognized on the balance sheet because it does not meet the recognition criteria. So for example, like most likely in KFC's balance sheet, there's no secret recipe because it's internally generated. Similarly for Coca-Cola, the brand Coca-Cola is, I think it is the most valuable brand in the world, yet it is not on the balance sheet because it's all internally generated, right? So when someone comes along, certainly they want to buy the brand as well, or they want to buy the recipe as well. So now an amount is, they're paying a certain amount for that recipe, for that brand. So because an amount, an objective amount can be determined, the asset now becomes identifiable. So that is why it's very important that you include all identifiable assets and as well as liabilities. So here you can see we identified the secret recipe. It is not recognized in the separate financial statements because it most likely did not meet the accounting standard. But now that we have an acquisition, we now have to recognize it, and we're going to recognize it at fair value. Very important. The land is in the books at 200, but we don't want 200. We want fair value, which is 300. So the adjustment we make, we don't make an adjustment of 300,000. We make an adjustment of 100. Here we made an adjustment of 180 because the books have 0. We want 180. Therefore, we adjust for the full 180. Here we want 300. The books currently have 200. So therefore, we adjust for 100. Okay, take note. We don't care about the 210 because that is after acquisition date. Here they say DEF had damaged inventory with a carrying amount of 20,000 Rand on hand at the acquisition date with the estimated value of 16,000. So we want it to be 16,000. It's currently 20,000. What must we do? We're going to have to make a fair value adjustment downwards of not 20, of not 16, but of 4,000 Rand. Okay, they're saying the fair value of a share held by non-controlling interest amounted to 16 Rand per share. Okay, all we have to we first have to find out whether how do they measure NCI. Okay, so that's very important. So here they say apart from the above issues, all the assets and liabilities were deemed to be fairly valued. So there can you see all assets and all liabilities were deemed to be fairly valued except the ones above, and no additional assets, liabilities, or contingent liabilities were identified. So those additional assets and those additional liabilities is referring to an example like the secret recipe. Okay, so the secret recipe is not on the balance sheet. So that was an additional asset that was identified. So they're telling you besides the ones above, there were no other additional assets or liabilities or contingent liabilities. And also telling you, apart from the above, all assets and liabilities are deemed to be fairly valued. So remember, why are they telling us that? Because that is one of the criteria of the acquisition method in terms of IFRS 3. Okay, so I just want to go have a look. how do we measure NCI? So they'll tell you here in the additional information. Investments according to ABC, appropriate.
Not 8.
Oh, yeah. So ABC elected to measure non-controlling interest at their fair value at the acquisition date. Okay, so remember, they'll have to tell you what is the policy of the company. So there's two policies, the proportionate share or fair value. Okay, so here they're telling us it is fair value. So the way we do fair value, we simply take 16 Rand per share multiplied by the number of shares. So over here for NCI, it is going to be 16 Rand per share multiplied by the number of shares. So remember, the total number of shares is 100,000. And they have a 25% interest. Okay, so the number of shares they would have is 25,000 shares. So 25,000 shares times 16 Rand will give us the fair value of NCI. So 16 Rand per share multiplied by the number of shares. The total number of shares of DEF is 100,000. We acquired 75, so they 75%. So therefore NCI must be 25. So therefore their amount would be 400,000, whatever it is. Okay, now we can calculate the fair value of the net identifiable assets. Okay, so fair value, yes.
Is it my network or I can't see your X-ray anymore?
Oh, sorry, my mistake. Okay, can you see here?
Yes,
That's how I calculated NCI. Okay, so 16 Rand per share multiplied by 100 shares times 25%. So they have 25,000 shares. Okay, you happy with that?
Yes.
Okay. Now we're going to work out the fair value of the net identifiable assets. So the fair value of the net identifiable assets, you just start off with equity. Okay, so they gave us share capital and they gave us retained earnings. Okay, so I think retained earnings was given to us 1250 and share capital was 100,000. Okay, so this is total equity. Remember, assets minus liabilities equals equity. So generally we just use we want assets and we want liabilities. Okay, so we want assets and we want liabilities. But what you must know, assets minus liabilities is equal to equity. So therefore we can start off with total equity. So total equity is this amount. But remember, assets minus liabilities or equity per the balance sheet is carrying amount. We don't want carrying amount, we want fair value of assets and we want fair value of liabilities. So they told us there are some fair value adjustments that we need to make. So based on that question, the fair value adjustments were the secret recipe. So the secret,
sorry,
yeah.
Sorry, Faiz, I think something I got distracted. My network, I lost you somewhere when you were talking about the retained earnings. I got the share capital, but I lost you on the retained earnings.
So the so the retained earnings and the share capital, that is the equity. So we just add all of that together, okay? Because that, remember, we want assets and we want liabilities. So assets minus liabilities equals equity. So therefore we start off with equity because it is the same thing as assets minus liabilities. But total equity, whether it's asset minus liability or total equity, That is all based on the balance sheet, and the balance sheet is carrying amount. We don't want carrying amount, we want fair value. So we have to make fair value adjustments, and they're giving us the fair value adjustments. So remember, we need to do two things: fair value adjustments, and we need to take into account additional assets, liabilities, and contingent liabilities. So the additional asset in this case is a secret recipe. A secret recipe is an intangible asset. Okay, you must know it's an intangible asset. So you must call it intangible asset, don't call it secret recipe. Okay, so that was given to us as 180. So remember the books don't have a secret recipe. So therefore it is 0. So to bring it in, we must bring in the full amount of 180. Okay, and then we do a deferred tax adjustment immediately. Deferred tax, it is going to be just the opposite, that multiplied by 28%. So you will apply whatever your tax rate is. Okay, the next one was the land. Okay, so we're going to make an adjustment on land. The land, we want it to be 300. It is currently at 200. So the adjustment is 100. So it's 300. We want it to be 300. It's currently at 200. So therefore the adjustment is 100. Okay, then we again have deferred tax, and deferred tax is going to be the opposite, negative. So it is that multiplied. So remember, in South African law, capital assets are going to be taxed at a CGT rate, which is 80% times 28%. Okay, I don't know if you guys have something similar. Okay, the next would be, what was the next? Okay, the inventory write-down. The next would be the inventory write-down. So here we're going to say inventory is a write-down. Okay, so it's going to be, the damaged goods is have a carrying amount of 20,000, but it is actually worth 16,000. So therefore we need to write it down. We want it to be 16,000. It is currently at 20,000. So therefore it is a 4,000 Rand write-down, and then we're going to have deferred tax on this. So deferred tax is going to equal the opposite at 28%. So therefore, the fair value of the net identifiable assets as is required in terms of IFRS 3 is going to be the sum of all of these. So just do. Okay, so now I can just go plug this in. So my fair value of my net identifiable assets is going to be that. Okay, so therefore my goodwill, my bargain purchase gain would be as follows. I'm going to say equal that plus that minus that. So it is a positive amount. So I have a goodwill of 173,000 Rand. So I have goodwill of 173,000 Rand. Okay, so are we happy with that?
All right. So on the calculation of net identifiable assets, Faiz, can you can you help me out on the deferred tax issue?
Yes.
We are in our books, right?
Yeah. What do you mean you are in our books?
Okay. Probably. Let me say the calculation for the deferred tax on the intangible assets and the inventory. forming part of the NIA.
Yeah.
What's the idea behind the calculation of the deferred tax for those items?
So it's specifically mentioned in, it is specifically mentioned in the accounting standard in IS 12. Just think about it. Remember, deferred tax comes as a result of a difference, a temporary difference between accounting treatment and tax treatment, right? So in terms of tax treatment, they're going to have land. So remember, we use a balance sheet approach. So we say carrying amount versus tax base. So the tax base is going to be cost price minus it's going to be cost price minus all the tax allowances, and that's how tax is going to get to their tax base. From an accounting perspective, we must use our carrying amount. Now, when you have a group acquisition, the group's acquisition is now going to be fair value. So therefore, the tax in the separate financial statements can be very different from what the group has. So therefore, the group's deferred tax must represent what they have according to their assets. And that is basically why we're doing this whole deferred tax amount. It is just following the principles of deferred tax. So the carrying amount now from the group perspective is different from the separate financial statements. So that is why we need to adjust for, because making a fair value adjustment, we need to also adjust for the deferred tax consequences.
Okay. All right. Thank you, Faiz. Can you take your screen down a little bit, working 3? Thank you very much for the explanation. All right. All right. Thank you, Faiz.
Okay. So that was actually answering part A of the required. Okay, so if I just share with you part A of the required, actually you have part A. So if you go to you have it open. So the first 10 marks was calculate the goodwill or gain on a bargain purchase arising from the acquisition of the interest. Okay, so we went through that. Okay, so basically, I didn't realize it was part of the required. But basically we answered that required. So we got full 10 marks. So this over here, this here is correct. And we got a full 10 marks. So that is part, I didn't realize it was actually part of the question. I always just do the goodwill calculation because we're going to use it eventually somehow. So that was actually part of the required. So therefore we did part A. Now, part B is for the next part of the question. So I'm going to do part B and part C in the next lesson because we're going to need to read the whole entire scenario for the next company. So I'm rather going to do that in the next lesson. So if you have any questions you want to ask me now, please ask. And then in the next lesson on Wednesday, we will continue with the question. Yes.
I think I've got a challenge in knowing elimination journals.
Yes.
I know of dividend and of, if for example, they are renting out income.
Yeah.
Any other, I'm struggling to understand them. How do I pick them up? This is an elimination journal.
Yes, so tomorrow in the next lesson, we'll cover that because it's in this question.
Okay.
Any other questions?
I think
Sorry, Faiz, can you share your Excel once again? I think at the bottom, there's still something that I think I missed out. Okay.
Okay, so I shared with you now the Google folder. So there you will find all the spreadsheets. So for those of you who don't have a Gmail account, you will get an email to say you must request it from me. So you're gonna have to click a button and then that will come back to me and then I must click a button. Okay, for those that have a Gmail account, you would have access immediately. For those that don't have a Gmail account, you first have to request access, and then that email gets sent back to me and then I must say yes, okay, and then that's how Google works if it's not a Google account. Okay, so just make sure I know some of you don't have a Gmail account, so then you're gonna have to do that Exodus process. Is there any other questions?
Not me.
Okay, there's no other questions, then we will continue on this one in the next lesson. Okay.
Thank you, Faiz.
Okay,
Okay,
bye-bye.
fine.
Thank you, Faiz.
Okay,
Thank you.
pleasure. Bye-bye.
Thank you.
Pleasure. Bye-bye.